The contribution format income statement. The contribution format income statement is used internally to determine profitability and to make decisions. Why use the contribution format? The contribution format is powerful because it segregates variable from fixed costs in order to observe the behavior of these costs. It can demonstrate how cost behavior will affect profitability. It can demonstrate how profitability will change from scenario to scenario if the cost structure changes. The cost structure is a proportion of variable and fixed costs in relationship to total costs. So in one scenario, there could be 70% variable cost and 30% fixed costs. Or in another one, if you change the cost structure, it could be 40% variable and 60% fixed. The contribution format can also be used to more accurately predict future behavior for budgeting. So let's compare it to a GAAP income statement. In a GAAP income statement, we will have sales, cost of goods sold, yielding the gross margin, from which we will deduct selling and administrative expenses in order to come up with net operating income. Now, the contribution format income statement will use the same numbers and will come up to the same net operating income, but it will segregate its costs between variable costs here and fixed costs here. So the sales are the same between the two income statements, but the variable costs are all accumulated together. So cost of goods sold is considered a variable expense because cost of goods sold does not come into being unless something's sold. So it is in direct relationship to sales and therefore is always variable in relationship to sales and is considered a variable expense. We also have a variable portion of the selling expenses and a variable portion of the administrative expenses. If you take the $7,000 in variable expenses and deduct it from the total sales, you will have what is called a contribution margin. Now, why is this called the contribution margin? Because this is the amount, $5,000, that is left to contribute to the remainder of costs associated with these sales. These variable costs are directly associated to the sales. So you will always be spending in relationship to this $12,000, $7,000 in order to complete those sales. So that means in order to make this money, to have these amount of sales, you had to spend this money. So this means that this will always be a percentage of the amount that you sell and will be gone as a result of these sales, and there will only be $5,000 or 42% left over to contribute to the remainder of your costs. So that's just why it's called a contribution margin. So you're spending this money in order to make this money. In order to do that, you're only going to have $5,000 left out of the $12,000 to contribute to the remainder of your expenses, which are all going to be all of your fixed expenses. So we had a fixed selling expense, a fixed administrative expense, totaling $4,000, and we come up to this same net operating income as we did in the GAAP income statement. We are just looking at cost behavior when we look at the contribution format income statement. So uses of the contribution format income statement. It will focus on cost behavior. The variable costs are incurred as part of making the sale. They are a constant percentage of sale, 58%. You will spend this money each time to make a sale. Therefore, the contribution margin, or 42%, 5 divided by 12, is what is left after making a sale that can be spent on fixed costs and to make a profit. It can be used, the contribution format income statement can be used to determine profitability, and it is used internally. It is not something that you publish to external users of the financial statements. It's used internally in order to run through various scenarios and to look at profitability. It can be used to predict how changes in the cost structure will affect profitability. So, in other words, if you decide to incur additional fixed selling expenses in order to increase sales, it will change the cost structure because these fixed expenses will be a larger portion of the total costs because you decided to spend more money, say perhaps on advertising, in order to increase sales. And it also can be used to budget more accurately because you will have separated out what is variable and what will change in relationship to sales as sales go up and down, but the fixed portion will remain the same. So it can be used better to help better budget.